Okay, so today we're gonna focus on controls, a very, very big topic um, in audit. So there are two types of things that we can look at in terms of controls, or two types of questions, perhaps. Because remember, it's guaranteed that in an audit paper you'll have a controls question, you will have a ROM question, a risk question, whether it's risk performance procedures or a ROM, or so it's ROM, controls, and substantives. You're always guaranteed, as well as ethics, because what's audit without ethics? So normally there are two types. So we're looking at control deficiencies. So control deficiencies. And this also has two legs. So we either have missing controls or inadequate controls. Right? So the control is there, but there's just something missing there. So that's what we need to do. Or we just need to test the controls, test of controls. Those are normally the main questions that we do get asked based on controls. Let me just see what I'm missing. So with controls testing, right, I think one of the key things is test of controls. Test of controls, right? The main thing is that you need to understand that there are two types as well. So two types. And in the two types, we have fully substantive approach, and that is the test of detail. So test of detail, or we have the combined approach. Combined approach, and that is test of detail plus test of controls, right? And normally this is determined when you do your NTE. So NTE helps you to determine, are we gonna test the controls or are we gonna not test controls? So test of detail is basically substantives and no controls testing, because you cannot rely on the controls. So substantives only. Okay. And then another important thing is for you to identify the significant risk. So also identify the significant risks. Right? And therefore, with significant risk, then you will test of details, because we can't really just rely on a control working and trust that, everything is fine. And then we state the assertions covered and tested. So this one is a tricky one, but normally this is something you'll be told. What do you need to state the assertions covered? So remember, assertions, state the assertions covered and tested. Normally in the question, you will be given the assertion that you are testing. So you won't really say, this is for this is for that. And also the assertions just help you with concluding, right? So remember, for balances, right? So balances, it is FP items, financial position items, and technically we have serve. So serve, and basically It is completeness assertion. So we tested this to ensure that the balance is complete. We tested this to ensure that it exists, so that is existence. And we tested this to see we have the rights and or obligation, right? And then here we have valuation, allocation, and accuracy. Allocation, normally we see it in inventories when we have like overheads and how we allocate our overheads. Maybe we can also see valuation come in when it comes to maybe accounts receivable, when we have different revenue line items, and or even IFRS 15, when we have contracts with customers, our contract assets and stuff like that, and we're allocating the transaction price. But yeah, basically the allocation of costs. Are we supposed to allocate this, or are we expensing it? So that's where allocation comes in. So with rights, normally in reference to assets, and obviously obligation is liabilities. Right? Liabilities, completeness, existence. So normally for completeness, significant risk. Oh, now yes, so like, okay, let me just put this somewhere else. So like I said, obligations is in relation to liabilities, right? Because liabilities, it's a obligation. Can I have the definition? Conceptual framework definition. Let me quickly look that up. Should be ashamed of myself. So conceptual framework, liabilities per the conceptual framework. Not knowing how to spell. And also, guys, remember the disclaimer, this is me also studying. So it's not necessarily a straightforward tutorial session, but just, showing you my thought process and how I study and tackle or try to break down certain topics that I normally struggle with, and hopefully it can also guide you in your studies as well. So yeah, liability is a present obligation of the entity to transfer an economic resource as a result of a past event. And then obviously asset would be the right. So liabilities, obligation is there in the definition, whereas rights is in relation to assets. And it makes sense. When we have an asset or liability, we can either have something that gives us the right to something, and obviously once we have a right linked to an underlying item, the party that's supposed to give us have the obligation, right? So you really need to look at it. Sometimes we might have the asset and it's supposed to give us the right, but if we pledge it, that's where the obligation part comes in, because normally when we pledge an asset to a bank, we're saying that upon default or in case of default, you guys can take this asset as yours. So technically, should we default, then we don't have the right, but rather we have the obligation to give to the bank. Hence I said it's and or obligation, depending on whether do we have pledged items in our balance sheet or not, right? So remember, an asset is a present economic resource controlled by the entity as a result of past events. So as I was saying, to complete the thought, completeness is basically a significant risk for liabilities. Okay, let me just say a risk for liabilities, and you most probably will have to perform test of details. And then always, therefore, this is a significant risk for assets. So existence is a significant risk for asset, and completeness is a significant risk for liabilities. And it makes sense, right? Remember the prudence principles? Back in high school, if you did accounting in high school, we had, I think, 6 GAAP things. And basically we have the matching principle that says that we match everything to the break period, and that can be linked to cut off. And then we have the matching principles. Let me just switch them out. So we have the matching, we have the prudent and prudent principles. Sorry, principles. Basically, the prudent principles was making sure that your assets are not overstated and your liabilities are not understated. So let me just quickly get this, if I can get. Yeah, we have the accrual principle, we have the matching principle, we have the going concern principle, we have the historical cost principle, the economic entity principle, and the prudence principle, and the materiality principle, right? So yeah, this is where it comes in. So existence, basically, there's a risk that our assets will be overstated, right? And then whereas with the completeness, there's a risk that our liabilities will be understated. Hence, there is a significant risk. And they go vice versa. So if existence is a significant risk, then we won't worry about completeness, because everything that needs to be there will be there, right? It's just that there's a likelihood of fictitious items being there. Whereas with completeness, everything that's supposed to be there, chances are it's not there, right? Because we want to display that we are managing our ratios properly. Therefore, there are certain liabilities that may not have been disclosed, but they're supposed to be disclosed. So yeah, if completeness is a significant risk, then the existence is there. Like, yes, all these liabilities do exist. It's just that not every liability is disclosed, and that's the problem. Therefore, the financial statements do not faithfully represent that those liabilities or those assets, right? And lastly, I'm going to cut it off soon. We have the balances. The transactions. So when we say transactions, right, we are speaking of the P&L items. And normally these ones don't have balances because they get closed off to retained earnings. So we have COCAC, right? COCAC. And then COCAC basically means completeness, right? And then occurrence, yeah. And then we have cut off, and we have accuracy, and we have classification, right? And normally the same is true here for expenses, because it's similar to liabilities. Significant risk for expenses, and then significant risk for income, right? And then cut off, basically matching principle. So we can say matching principle, matching, and accrual principles come into play here if you're going back to the GAAP principles. Okay, and then obviously, was it accurately? This is the valuation, right? So accuracy would be linked to valuation, allocation, and accuracy in assets. And then occurrence would be linked to existence. Completeness is obviously completeness. Classification. And then these both have, so both the balances and the transactions have P and D, which is presentation. So they both have presentation and disclosure, right? They have both presentation and disclosure requirements, right, for all assertions. So financial position items, it's SERV. Transaction items, it's COCAC. And that's what helps me when I'm dealing with a specific transaction, right? Accuracy, was it correctly calculated? Classification and presentation can be used interchangeably, but they differ, right? Because when you think about it, here we're trying to figure out Is it income? So is it an income or expense, right? Because it's a transaction. But then when it comes to the presentation, it would be, is it accrued income or expense? That type of thing. Same thing, because on the P&L it should be disclosed as an income or expense, and then in FP it should be disclosed as an income, an accrued income, or an accrued expense, or even a prepaid expense if we paid for the specific obligation upfront. That sort of a thing. Yeah, I think I'm gonna cut it off here, and we'll dive deeper into the other things.